Mike, welcome back to the show. Good to see you again.
Great to be here, Dan. Been a while.
It has been a while. It's been what? It's been a
Three
year or
three
more,
years. No,
at
no, no. They
least.
they told me the sheriff
Three.
told me it's been about 3 years. So y'all finally made
Wow.
your way back around to
Yeah,
me.
before
So
my time
Okay,
on the
yeah.
podcast. Yeah.
that's right. That's right.
Yeah. All right. Well, time flies when you're getting old, so that doesn't
Hmm.
surprise me. That it was three, and I thought it was one. And a lot's happened since then. But of course, the most important thing that we need an update on is the pecan plantation and the golf course.
Yeah.
So let's start with pecans. How's that venture coming along?
Well, gosh, it's not going so good anymore. Unfortunately,
Wow. Oh.
I I'm thinking back. We last were on this in 21. I think probably
Mm,
November, December of 21. We had a really bad hurricane come through. If you remember the one that hit Fort Myers in 22, it was vicious. That storm ended up coming across the state. The eye of the storm came right over my place, and I've
mm,
still got several trees, pine trees that are permanently, doing this. But it dropped about 15 inches of rain on us. My home
mm.
became an island. I never knew what island living was going to be like, but I learned that quickly what it was. It's not so much fun.
Whoa.
And that high water table just was more than a lot of the trees could withstand. They're still out there, but they're just not doing so well. So the good news is,
Hmm.
I guess, what I've learned about life, there's always two sides, right? The bad news is the pecan business isn't as good as it once was. The good news is I'm spending more time playing golf out there. The golf
All
course part of
right.
it is great. So, yeah, I've got about 9 holes that I can play 3 times a week.
Mhm.
I don't have to worry about standing in line behind somebody else. If I don't, if I'm not doing well that day, I just pick my ball up and go back to the house. So yeah, it works out great. It's really more like I call it a redneck top golf course because I've got
Yeah.
markers set up to hit to. But yeah, it's fun.
Mike, I love the way you describe everything as redneck. Like the odds are when I email Mike, he's going to say redneck. The response is going to contain the word redneck,
Do you have your own
um,
golf course, or is it just
which is
near
endearing.
where your house?
No, well, what I've done is I have a 22-acre farmstead, and I've got pecan trees on about 6 acres of that. Uh, Over the course of that, about 12 acres of it, I've carved out a little golf course just for myself and friends that come over and play. And I get 2 hours of exercise a day, and this is a great way to supplement my exercise. Was to just go out there and hit about 30 balls. Takes me about an hour and a half to get around the course, and then come back in and do the rest of my exercise. So yeah, it's been great, and I get to enjoy. One of the things I love is birds. I get to we in the wintertime, we've got all the migratory birds that you can imagine that come into Central Florida, and I get to be out there with them and hear them and just experience wildlife. Just walk in a peaceful environment for a couple of hours.
That's great. Yeah.
So on our golf course, we live on a golf course as well, and the of course the geese are like they're not just regular geese; they're like attack geese. Tasmanian devil geese or whatever. You know what I'm saying? They're aggressive. Do you get the aggressive geese on your course?
We don't have geese, but what we do have are sand cranes. That's a protected
Oh.
species, but boy, you wouldn't know it around here. They love my place because we keep the grass cut down close. Obviously, you can't
Hmm.
play golf unless the grass is cut close, and
Hmm.
they're bug feeders. So let me tell you, they're all over this place, and they don't know the risk that they're taking when they're out there on the golf course and I'm hitting the balls. But so
Yeah,
it's but
yeah, yeah. We've had a few balls hit the house. Um,
oh
so,
no,
yeah, it's
part of it.
par for the
Par for
course.
the course.
Yeah, um, yeah. I mean, bad bad pun. So great. I mean, like you say, when the pecans aren't working, you can still play golf. That's
That's right.
good. That's a good thing. I still need to get to your place. I still haven't been to your place. I need to get down there and check it out. Maybe hit
Well,
a
you
few
got
balls.
close just a couple of weeks ago, right? You were down in Boca.
I Yeah, yeah. I was in Boca for
About
Rick
four
Rule's
hours. That's about 4 hours
conference.
away. It's
4
worlds
hours.
apart from
Okay.
where I am, but it's about 4 hours away. So
Oh, I bet. Yeah, I mean, Boca's great. I love the coastal areas in Florida, but I'm dying to get there. I'm dying to go up to your place and see it.
I've even got a set of golf clubs here from the Goodwill, the local Goodwill that we keep on hand for folks that come from out of town. So if you come, you can play golf with me.
All right. It's funny because Lori got me a set of clubs. I never used them, and then she got rid of them. They, who knows? Might be the same set. Um, so let's get a little serious. Things have changed for you here at Stansberry too, haven't they? In the past couple years. What I know, of course, you've been with Extreme Value. You've been my partner in crime with Extreme Value, and basically you're the heart of Extreme Value. I don't know if everybody knows that, but Mike runs the model. Like when I want to know what stock we might do in Extreme Value, he's the first person I ask. Unless I've got an idea that I'm just chomping at the bit to get out to you. But besides that, Mike does other things. What other things are you doing with Stansberry these days?
Well, after we talked last in 21, since then we've launched the Select Value Opportunities product. I think August of 22. So it's been almost 2 years now that's been in place. I was writing 10X Investor as well. That's been folded into, we just consolidated at the end of last year. So both of those products are housed under one now. So yeah, that publishes weekly, and it's only for Alliance members. So that keeps me pretty busy working on that on a weekly basis. Publishes every Wednesday.
Weekly. I know what it's like to have weekly. Weekly is tough. And weekly is tough for when you have to. Are you picking a stock a week?
Potentially. It's interesting. The nice thing about the product is we go with the flow. I mean, it's really more of a, I'm not going to call it a trading service, but it has a more trading atmosphere around it. Last year, October of 22 was a major market low. I anticipated that at the time, and over probably the next 12 months, I think we made 18 picks or so, probably double what you would typically do on a monthly service. Now, interestingly, as valuations got high and there weren't as many things to choose from, we haven't made as many this year as things got really out of control. We've just started in the last couple of weeks adding new ideas, but the nice thing about doing it weekly is I'm under no pressure to add picks. I add them when they make sense, and if we go a long period of time without making a pick, then we go a long period without making a pick.
Right, and you have tools in that. Like I've seen people refer to it as like a tool too. The different filters that you have in there as too, right? Yeah.
Right. Yeah, that's true. Yeah, it's more than just a get a newsletter each week. When we started the thing 2 years ago, the idea was to find a way to consistently beat the market, and to do that by taking less risk. And I'm proud to say that we've been able to accomplish that. I updated the statistics as of yesterday, which is July 18th. Our average return is about 14.5%. That beats our benchmark by 6 percentage points. And I'm also happy to report that since I started tracking the statistics the first week of January of 2023, we've got nearly 80 consecutive weeks of outperformance. So what I wanted to accomplish, we've been able to accomplish. And, it's been kind of a wild ride the last couple of years. So there's been some crazy highs and some crazy lows. So I'm very happy about that, and looking forward to more of that in the future. But yeah,
So Mike,
I'm sorry, Dan, to go back to Corey's point about it being system, one of the things that we do is we focus on, and one of the reasons for the outperformance is we focus on 100 stocks. That's all we recommend is 100 stocks, or from a list of 100, curated list of 100 stocks that are the best of the best. They constitute about 50% of the S&P 500 and about 65% of the NASDAQ 100. You know, these are well-known names: Google, Amazon, Honeywell, Roper, Dollar General, Walmart. You get the picture. And so what
Mhm.
we do is I update the valuations of these things 4 times a year. Every time earnings come out, I update the valuation. And we track the prices of them daily in relation to those values. So each day we get the subscribers get access to a new ranking from 1 to 100, from the most overvalued, from the most undervalued stock, all the way down to the most overvalued stock. And it shows you what we think about each of these in terms of their valuation in relation to their price. And one of the other things I'd mentioned about that is that, you know, I was thinking back as we were going to do this, about the catalyst for this whole thing really was the idea that, as you know, the best stocks in the market oftentimes only become undervalued for short periods of time. And you can't always tell
Right.
when that's going to happen. I mean, oftentimes it happens when there's a big market downturn, but oftentimes it's also a function of investors not understanding the growth opportunities, or the upside in the growth part of the story. And so I figured out pretty quickly that the only way to find these things at the right time to get into them when they were undervalued was to begin monitoring them on a daily basis. And so let me put out a kudos to the IT team that has built this system and monitors it on a daily basis. It is absolutely fantastic to be able to go in
Yeah.
and see these stocks re-ranked every day, 1 to 100, and to maintain all of the data that goes in behind the scenes into this system that I put into it. It's really phenomenal what they've done, and
Yeah.
and I think
It
I
really
hope that
is.
subscribers get a lot out of it.
And I have to say, you know, of course, like we've worked together for, you know, long time and stuff, but still I have to tell the listener that as Mike gives kudos to the IT, I give them to him because he had a whole career like valuing real estate before he came to us. Like he's like Mr. Intrinsic Value across all Stansberry as far as I'm concerned. Like he does things that I can't do. I mean, I guess I could if I worked as hard as he does. But frankly, I don't have his experience is what I'm really trying to say. And he came in and he built like this core kind of engine that we use in extreme value. And obviously he's done the same thing for select value opportunities. He's like, you know, it's like my personal valuation guru. He's just he's right there, and that's a really super valuable thing to have. Now, all this talk about value, people are, oh, value doesn't. Well, you know, like Mike said, it is often, very often these days, about misunderstood growth opportunities. In fact, as soon as you said that, Mike, I was like, isn't it? It's mostly that. Like that's really what we are doing in extreme value for the past several years, right? We're looking at the share price and the current market valuation and saying the market thinks this stock is not going to grow at all, or maybe is going to grow like, you know, 1 or 3% or something, and we think it's more like 5 to 7, but you know, just ballparky numbers, something like that, right? I mean, it's become more about that than, you know, finding something. We don't do
Yeah,
stocks like trading at discounts to book value and that old style stuff. We're doing this. This is what
right.
value means today,
Yeah, and
right?
one of the greatest things about the system that we use is it's based on expectations, right? I mean, I want listeners to remember and to understand is that valuation's about what's going to happen in the future. It's not about what's happened in the past. It's about
Right.
quantifying the expectations of what's to come still. It's about modeling those cash flows that are still ahead. And for me, that was easy because I spent, as you mentioned, a career valuing hotels and shopping centers and multi-rise office buildings and so forth. In the good old days, I would get a couple of bankers boxes filled with stacked with leases, 40, 50-page leases that I'd have to go through and manually put into spreadsheets and understand what those cash flows, as contracted cash flows, were going to be over the next 5 to 10 to 15 years, understand what the market rents were, and condense that all into a sense of what the future looked like for that particular property. It's easier to do all of that in the equity space because of all the data we have access to through FactSet and other things. But because I've had that long career modeling cash flows, this is second nature for me, and that's really what it's all about. So, but the point I wanted to make is we can quickly ascertain what the expectations are that are implied in a given stock price. That is really important, because once you understand, something else I'd mention. Intrinsic value is mostly about revenue growth, operating margins, and free cash flow margins. And so when a stock is rising day after day, week after week, month after month, what that's telling you is that investors are raising dramatically their expectations for those three things. The reality is, at some point, there's going to be a disappointment because they just get far beyond. And so when you can understand where the stock is today in relation to those expectations and what a more realistic view of those expectations is, it gives you a leg up on most investors.
Oh, well said. Yeah. And my sort of nutshell explanation of what you do in SVO, to a great extent, and what we do in Extreme Value is the old style would be to essentially, when you forecast those cash flows and margins, you're looking ahead and kind of making a prediction about growth. But what you're talking about and what we do, it kind of flips that on its head, and it looks at the current valuation and says, what's baked into that? And then we compare what we think is more realistic to that. And I'm saying Mike does 80, 90, 95, sometimes 100% of this. So, it's that simple. You're like, if you know about discounted cash flow, we're sort of, rather than projecting out into the future and saying, what does that value look like today? We say, what's the market value today? And what do you have to project to get to that? And what do we think that is? That pessimistic? Is it optimistic? Is it somewhere in between? Is there an opportunity here based on that, that gauge of pessimism to optimism?
Right.
And it's just a superior way of looking at things. And I probably tell this story every time we talk to you, but I'm going to tell it anyway. This started for our Extreme Value newsletter when I sent Mike a book called Expectations Investing by Alfred Rappaport and Michael Mauboussin, the latter of whom we've had on the show. And he just kind of ran with it. Like I said, yeah, let's do this. And I started clunking together some spreadsheets, and I would do one and Mike would do 10 of them. And I was like, okay, well, I'm not going to compete with this guy. so Mike, you're in charge. You do that and I'll do whatever else is left, if anything.
Well, that was great, Dan.
Yeah.
It's funny because I talked to Porter's intern this summer, earlier this week, and he was asking me, one of the questions he had for me was there a defining moment in your investing career? And I told him, I said, the moment that I got that book from you, you sent that book to me, came in an Amazon package. I had no clue what it was. I opened it up, I saw the book, said, okay, interesting. I started reading it, and immediately it crystallized in my mind that all of the work that I'd been doing all those years in real estate valuation can be done the same way in the equity space, but even superior to that. And what I've done, in addition to the valuation model that you've talked about, and I've run through that thousands of times, is in the real estate world, it's malpractice to use anything less than 2 or 3 approaches to value. Most analysts in the stock space, they just look at multiples. They say stock's trading at $10, 10 times EBITDA. Its peers are trading at 8 to 10, so it's fairly. We do something totally different. We do this expectations analysis. But in addition to that, what I do is I look at actual closed transactions for public companies. And I look at what the expectations were that were in place at the time of that deal, and I understand what those expectations are that are baked into those multiples. And I've got a spreadsheet with about 350 transactions on it that I use to test the reasonableness of. So we go through this long income approach. We come up with a number, and then we can test that against what the market's telling us buyers and sellers have transacted deals at in terms of a multiple as a way of testing. Okay, is this really for real? And so, to me, that's a really important part of this process as well.
You said something interesting that's kind of stuck in my head now, and I'm really curious about it. You said that when you read about expectations investing in the book, that it crystallized and it was even superior to the process you used in real estate. And immediately I wanted to know, superior how?
Well, superior, and maybe superior is not the right word, but the sense that the reality that we have access, because you're dealing in public markets. In the real estate, you're dealing in private markets. And it's funny. I would appraise a hotel, and it would take weeks and cost tens of thousands of dollars because I had to go out and understand what people were paying for similar properties. I had to understand what the room rates were. Were there issues that were going to affect the development potential of nearby properties? It's a long, involved, private process. In equities, all of that happens transparently. Basically, we've got through FactSet and Bloomberg and other sources, we can understand what the what the estimates are, the consensus estimates that are being put out there by analysts, what they expect in the future, and what our belief is. Is it similar to that? Is it not? We've got all this information at our hands. I guess that's my point. In real estate, it takes you weeks and months to gather that information sometimes.
Right. Okay. Yeah, I can see that. Yeah, it's really cool what you've done. I just and the tool aspect that Corey mentioned about in SVO. Um, in other words, it's not just a stock pick. It's a real tool for investors. Um, can we talk about that a little bit more? Because that is, that's really, really important. It used to be in our business that you just, you found a stock pick, you write up your idea, you do your research and write it up and you send it to your reader, and that's pretty much it. But in the age of the internet, there's a lot more potential for interactivity. So how is SVO, Select Value Opportunities, more of a tool than merely a stock pick service?
I talk about this in the welcome letter. The fact that
Hmm.
if you're going to go out and buy a car this afternoon, what are you going to
Hmm.
do before you go buy it? Let's say you're going to buy a new Tesla. You're going to go on Car Gurus or whatever one of these sites, and you're going to look up that car, right? And you're going to get all the information on it. You're going to understand what other people are paying for it. All of that information has been consolidated into that website that gives you as perfect information as you can get at that moment to make your decision. Zillow does the same thing with housing, right? You could
Right.
punch in your address right now and immediately know this is what Zillow thinks your house is worth in relation to other properties that have come on the
Mm.
market. So my idea was, let's do the same thing for valuations. Now, understand that stock valuations are much more, as we've talked about, much more sophisticated than simply looking at what a house down the street has recently sold for, or a car recently traded for. You've got to look into the future. You've got to understand cash flows and all these things. But by basically democratizing value and putting it out there on a daily basis, in an instant, within 5 minutes, somebody can go through this list and say, okay, well, here are some ideas for opportunities, and here's where I know absolutely there is no opportunity from a valuation standpoint. Something else very important that I need to mention here: Select Value Opportunities requires two things. It has to be undervalued before we can make a pick. It also has to trigger a momentum buy signal. So we're not just about value. It has to be about momentum too, because a stock can be undervalued for months, if not years, before ever triggering a momentum buy signal. So that's really, really important. Those are the two things we require. We don't require that the momentum aspect of it in extreme value, although in many cases that is the case. It just happens to be that it probably is triggering a momentum signal, but it absolutely has to be in place in order to make a recommendation in select value.
Yeah, you're giving me shades of Mark Chaikin now, combining value and momentum.
Yeah, and I would say if any Alliance members
and it makes sense.
For some reason haven't checked out select value opportunities yet, you should. I mean, if you go on, you could type in the ticker, a ticker, and get the ranking that Mike mentioned from 1 to 100, and then you have a simple list too there of top 5 undervalued stocks with the discount to intrinsic value, and then top 5 overvalued stocks with the premium to your intrinsic value. So like it's right there on the front, and like that could give you a nice. I mean, if nothing else, it gives you a nice kind of just snapshot and list of things to think about, and can get in there way more detail, obviously, and get Mike's take and on the you do some macro in there too. I know I read the analysis you do each week, obviously, because it's a weekly, so you gotta you're writing up what's actually happening in the economy and the markets too, and what may be ahead. So yeah, it's
one of the things that, now that you said that, Corey, one of the things I wanted to mention today that's fascinating to me is to track over time how the distribution of fairly valued, undervalued, and overvalued for these 100 stocks. When the service first went out, and for the first year or so, the distribution was basically about 75% of the stocks were at any given day were fairly valued. About 20% were undervalued, and about 5% were overvalued. So 75, 20, 5. That's completely flipped in the last 12 months. Now, I just checked it yesterday or this morning, 60% fairly valued, 10% undervalued, 30% overvalued. 30% of the stocks that I track on a daily basis are trading at dramatic premiums in some cases to the values that we have assigned to them. It's really unprecedented, and it's a warning sign. And so a lot of the service's value, in my view, is to help people understand, hey, I'm thinking about Google, or I'm thinking about AMD or whatever. Go see what I think about the value in relation to the current price, and it may give you an insight that you didn't have before. Because to me, at the end of the day, once you know value and you have a conviction in value, you've got a valuable piece of information, because you know something that a lot of other people don't know, and it stops you from making bad decisions. I mean, if you knew for a fact that the house that you wanted to buy for $250,000 was not worth more than $125,000, would you go pay it? Of course not. But people do it all the time in the stock market, because they have this, they don't know, they don't understand what the value is. They don't have a strong enough conviction in the value. So they say, the talking head on CNBC just said he's buying NVIDIA or whatever. So they run out and buy it. But they don't understand what it's really intrinsically worth. And so then they're running for the hills when it turns down. So that's really
that's
important.
It's a really great point, because if, we've been in this business a long time, and we've seen a lot of feedback from readers. I've talked to many of them, probably hundreds at this point, over the many years at various conferences, including our own annual conference. And the big mistakes are, not sticking with something that's really great over the long term. I mean, there's a big mistake that I've made. It's a standard kind of human foible, but I get the most you get the most conviction generally from what you're talking about, understanding the value, understanding the business. And also, Mike, what you've done that I just want to point out is you've, before you get to any other work that you do on these companies, you've pre-vetted 100 companies that you're saying these are better businesses, these are the good
Right.
businesses, and
Right.
that alone is a source of enormous conviction. We had a huge winner in extreme value with Constellation Brands, which I think was it the very first stock you ever
It
brought to me
was.
when you?
It was.
Yeah, yeah, and dopey me, like, whiffed on it for I don't know how many months before I was like, yeah, this is good. Let's do this, and it's fantastic. It's exactly what you want. It's like a cash gushing brand name alcoholic beverage company. I mean, I've been drinking the same beer for like decades. People don't, they don't change, right?
It
So
started to a
it was
little
a
bit. Yeah.
fantastic idea. It turned out really well. Yeah, that's right. Turned out really well. And part of the reason we held on so long was because we had the conviction that it's such an excellent business. And there were major breaks in the share price. Like there was it went through this volatile M&A period, which is turns out to be a complicated thing that really benefited the company in the end. But at one point, like the deal was sort of off or whatever, and the share price was like tanked really hard. And one of the best things we ever did in Extreme Value was say, "Don't sell this thing, man. It's still a great business."
Mhm.
And then we came out the other side with even bigger returns. So this this idea of a sense of conviction by knowing what you own, um, I would almost say it's like one of the best things about Stansberry, and it comes from the top down. Like Porter learned, some time ago, when he started his research on capital efficient businesses, that a really great business is the most important thing.
Mhm.
And then from there, you decide, what the valuation is and whether or not you want to buy it right now and all that. But starting with a high quality business is the thing. And like Mike said, you really gotta know it ahead of time, because they don't get cheap. When they get cheap, it's not that often. It's usually not for that long, right?
That's right. And
So
I
like
remember,
all these ingredients come together.
I remember years ago when I first was involved with EVI and doing the searching for stock ideas, and I'd come across a great idea, but I was 2 weeks late because it had already moved dramatically from that undervalued. And so that was what triggered me to say, hey, we got to come up with a system that solves this problem, and that's what Silic Value has done. So it's
Yeah,
been.
I can remember at least once or twice over the years. The newsletter comes out on a Friday, so obviously we're doing a bunch of work before that. And that Friday the thing would open up 20%. Like Friday morning, we get up, we're ready to publish this thing, say it's really undervalued, and the market opens and the thing is up 25% or something. It's just,
Yeah.
like we're like literally hours late, with this recommendation, which is really frustrating. Um, but but it's a great idea. I was about to say, all those elements come together. High quality businesses, forget all the garbage, understand the value, and even add in momentum as Mike and others have done. And it's really powerful. And because, you can get the timing right, and you can get the valuation right, and you can get the conviction to hold over the long term with all these elements in place. It's really powerful. It's very similar to, it's it's just generally similar to what Mark Chaikin does. It's the work behind the scenes is actually totally different,
Hmm.
um, because you're building valuations, like you're building bottom up valuations, and he's using some valuation metrics. And frankly, I think what you do is, in terms of valuation, it's like the most powerful valuation model in all of Stansberry, like by a mile, because we know what the other folks do, and nobody does what you do.
We've
It's
had people.
you got a job for as long as you want one.
we've had subscribers ask you about expanding the list to 150, 200, whatever, um, which would be great. But the reality is, unfortunately, that it takes a lot of time to update these valuations 4 times a year. It's not an easy
Mhm.
process. And I got a sense for this when for a while I had an intern, or not an intern, but I had somebody working with me, um, another analyst here in the company that didn't know anything about valuation, and trying to help him understand the nuances of this system was very challenging. It was going to take a long time, and so what happens is you forget over the course of time how much you understand about something that someone else doesn't, because of all the work you've put into it over the course of time. And so yeah, I just think it helps people from making bad decisions when you know what the value is. You can relax because you're not going to buy. It doesn't mean you're always going to get it right. I don't always get it right. I can tell you that. But
Yeah.
most of the time, you're going to avoid the big mistakes and be there to take advantage of the opportunities when they present themselves.
Right. Corey mentioned, rightly so, that you do macro commentary and select value opportunities, and you and I have you know, exchange a few words now and then about the macro environment. Um, Everybody knows, my spiel on that right now. So let's not do that. But but what do you see when you look at, the overall stock market, the level of interest rates, these big sort of macro markers? How do you think about the current environment?
Oh, that's a good question. I have a couple of different things that I do. I have studied for decades cycle history, and I'm a
Hmm.
very firm believer in market cycles. Um, to me, the most important ones are the 4 year cycle that occurs from bottom to bottom. Generally speaking, it's about 4 years. Sometimes it's a little bit shorter, sometimes it's a little bit longer. And then the annual or seasonal cycle, which is about 12 months. And so I stay very attuned to those two cycles and where we are. And I try not to get too far out ahead and make big predictions about what's coming or what isn't coming. I try to focus on, here are the two cycles where are we on these two cycles, and
Hmm.
then I just try to stay a week or two or three ahead of the market and understand anticipate what inflation. And to me, we're talking about macro. I've said this for at least a couple of months. I think that inflation is becoming less of an issue. I want people to remember that the Fed has a dual mandate:
Hmm.
maximum employment, maximum employment. I'm sorry, and stability in pricing. Um, Pricing stability is becoming less of an issue. Maximum employment is going to be the big deal, and I'm starting to see this crop up in the Wall Street Journal and Bloomberg and so forth, because I've been tracking these unemployment numbers and employment figures for some time now. This is going to be the issue, and this is why I think personally that gold and silver are near all-time highs, because they anticipate that the Fed may cut rates, but that doesn't mean inflation is necessarily going to diminish from 3% to 2%, and it means that
Hmm.
real rates are going to decline from here. And as real rates decline, you're going to see gold and silver really take off, in my view.
Yeah, that makes sense. I still have a feeling like this strong anticipation that lower interest rates, an impending Fed cut, um, that people are way too sort of, um, it's monotone, right? They're just thinking, well, that's wildly bullish, and that's all there is to it. So buy stocks hand over fist, um, and ignore other. You wind up ignoring other things. We're on the same page there for sure, as far as gold and silver are concerned,
Well,
because
I've talked about the fact that just because interest rates are declining does not necessarily mean good news, right? I mean,
right,
go back
exactly.
to 2008, and that's why I say we have to keep an eye on employment, because in 2008, inflation was not declining; actually, it was increasing. But the Fed did not hesitate to cut rates because unemployment was beginning to soar, and as it continued to get worse, that's what's going to set the stage for gold to move higher here. Is that if they have to cut because employment is worsening, even if inflation
Mhm.
isn't improving, they're going to have to cut to keep that mandate of maximum employment.
Right. And the latest in this narrative, of course, is the Fed through Jerome Powell, of course, is saying, well, we're not going to wait for inflation to get down to 2% necessarily before we start to cut rates, which, the market loved, right? And I find that really incredible, primarily because the nobody seems to acknowledge, it's rarely acknowledged how insane the 2% target is. It's like saying we're only going to we're going to see to it that the consumer is screwed about 2% worth a year. In our opinion, it's okay to screw the consumer 2% a year. And the 2%, of course, is very obviously a kind of a suppressed number because people are paying a lot more than 2% more for a bunch of important stuff. And energy and food are considered non-core. I mean, we'll die without them, but they're non-core. I don't
Not
get it.
essential. Yeah.
So all of this, all of this narrative around these very popular, widely accepted data points is a bit insane to me. And I'll tell you, man, I sold some gold once, and it was the dumbest thing, one of the dumbest things I ever did. I'm not doing that again. Not with all this insanity and these popular data points, and as you say, the likelihood of higher prices for gold and silver. It's a weird world that we live
Yeah,
in.
Dan, to me
frankly.
too,
How do they get away with it? I don't know.
to me, the end outcome of what Mike's describing, which I totally agree, that unemployment's starting to pick up and inflation is becoming the past concern. Now it's going to be unemployment, as far as the Fed is concerned. Like, to me, that just ends up in the more inflation down the road territory, which, and then we get into that whole, what me and you've talked about plenty of times, like that longer term cycle of rates likely going up, but maybe this is a cut within a longer term rate cycle. So I don't know if you have any thoughts on that, Mike, too, but
Well, it's something that we haven't talked about yet is with regard to CPI, about 45% of the contribution is housing. And
Yeah.
housing inflation is running 4.5%. Now it's improved a little bit, but if interest rates start to go down, which they're doing as bond yields lower and interest rates go down, I think you see where I'm going with this, right? People are going to run back out there and they're going to start buying homes and pushing prices up. And what's going to happen to that 45% of CPI that's related to housing? It's not going to go down. And so my view is, and again, I think this is what gold and silver are telling us, inflation is not going to move much off 3%. And they're absolutely going to have to cut rates if unemployment becomes more of an issue. And I think it is an issue. I think when you look at the number of job openings, I hear anecdotally the stories of people out looking for jobs and they're not finding them. Read in Bloomberg and the Wall Street Journal the good reporting that's been done about people out looking for jobs. And what they're finding is that in many cases, the higher paying jobs are going away. It's the job growth is in the lower paying jobs. And when you put all these anecdotes together, you begin to sense that the employment picture is not really as great as maybe the big data is telling us. But when that scenario hits the big data, the non-farm payrolls report that comes out monthly, they're going to have to cut, whether that inflation rate's at 3% or 3.2% or whatever. And again, what's going to happen? Real rates are going to plunge and gold and silver are going to soar. That's the backdrop that I think we have to be prepared for.
Yep. Yeah, totally agree. Must prepare for that. Yeah, I've been thinking a bit about housing lately, and it's a head scratcher, except that the fundamentals underneath it kind of remain the same. And if you look at the longer term picture, like I've been thinking about other countries, Australia, Canada specifically, places where Chinese people have bought a lot of homes over the past several years. And, you know, you could say, well, the Chinese market itself is just in horrible shape, so they're going to have to sell something, and they still own plenty of homes in these areas. On the other hand, the real picture for real demand for housing, just stick to the United States, versus the supply is still pretty robust,
Mhm.
even with everything that's happened. And I think that may keep prices elevated. As you say, the rates go down, it could give another shot in the arm. And the just the backdrop, like the regulatory backdrop, it's not great in North America. In America, we have NIMBY sentiment, right? Not in my backyard. So there's a lot of regulatory issues. It's expensive to build housing. There's a great article in the New York Times about building multifamily housing is so expensive because elevators cost 5 times more in the U.S. than say in Europe or other places. And then you go to a place like Canada, and it's not NIMBY. The sentiment is banana, right? Build absolutely nothing anywhere near anything. Banana. So the housing is a really interesting play. I've exited early, but with substantial profits in the Ferris report letter. Um, Maybe quite a bit early. I'll have to see what I think, over the next few months. But uh, you know, overall, it's a very, very interesting backdrop there. So Mike, you actually, I had two more questions for you. One was what haven't we mentioned, and you mentioned that. And the next one, of course, is our final question, which you've answered before. It's the same question for absolutely every guest, no matter what the topic. And even if it's non-financial topic, I still ask them the identical question. And if you've already mentioned your answer, by all means, feel free to repeat it. The question is simply this: if you could leave our listener with a single idea or a single thought today, what would it be?
It's funny, Dan. I remember that there was a last question, and it was something along these lines. And I couldn't remember exactly
Right.
what it was, but I said, you got to be ready for it. I'm not ready for it, but
Nobody
actually,
is. I think it works better that way.
that's not true. I have given it some thought, and my answer will make sense. Um, Earlier, I mentioned that Select Value has had a good run. We've outperformed the market for a long period of time, and substantially. And so the question, of course, is why? Why has that happened? What are the underlying causes of that? We've talked about it. One of them is, of course, we're sticking to elite companies, the best of the best. That's a big part of it. We're waiting until they're priced properly, and we're only buying them when they trigger momentum signals. But what I haven't mentioned that I want the listener to take away from this today is the other ingredient that's really important is aggressively managing your portfolio. Now, if you're somebody like an Extreme Value, we tend to buy stocks for the long term. If a stock goes down 15%, we're not as uptight about that as we are in Select Value because we've got a shorter time period. We got a different mandate. But here's what I wanted to mention. I did address it earlier. This idea that you let your winners run and you cut your losers has been a very powerful source of performance for Select Value. We don't take losses. We abhor losses. And so when a stock moves against us, we don't wait until it's down 25% or 20%. We cut that bad boy quickly before it gets out of control. Now, yes, do we sometimes cut and then a month later it takes off? Absolutely. That happened with NVIDIA. Last August, we added NVIDIA. Nobody else thought it was undervalued. I pounded the table for it for 6 months. We ended up closing about a 60% profit in 8 months in it before it stopped us out. But I want to make the point that don't don't be shy of cutting your losers and letting your winners run. It's not as easy as it sounds, but it has absolutely been a source of outperformance for Select Value, particularly during down periods. So yeah, that's what I wanted to mention.
Excellent. That is a wonderful message. We've interviewed, turtle traders and all kinds of other folks, and that message aligns extremely well with some people who have gotten extraordinary returns over long periods of time. So thanks for that, and thanks for being here, Mike. Always great to
Yes,
talk
sir.
with you. I can't believe we've known each other all this time, and we almost never talk on the phone. It's like 5 words by email every month or something. It's
Well, we're
crazy.
just kindred spirits at this
Yeah.
point, Dan.
Well,
We
we'll
are,
have to get
that's
you
right.
together again soon here on here then.
Okay, sounds good.
Yeah.
Sounds good.
Yep. And I am coming to Florida. Because I might just show up at your door one day. If my schedule allows, it's going to be like, hello, hey, Dan's here. Let's he's got his own club.
Bring a 7
Let's
iron.
go.
Come on
Bring a
down.
7
Come
iron.
on
Sorry.
down. That's right. Yeah, you don't need anything too big, but we'll get it done. So.
All right.
All right.
All
Take
right.
care, guys.
Thanks a lot, Mike.
Yes, sir.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.